Hello everyone and welcome back to our YouTube channel. Today we are diving deep into a topic that concerns almost every Indian household and investor, the taxation of gold in India. Whether you are buying jewelry, investing in bars or considering sovereign gold bonds, understanding the tax implication is crucial. So let's break it down into simple terms. Gold taxation in India mainly rests on two pillars. First, what you purchase when you purchase gold, and second, what tax you incur when you sell it. Let's start with the purchase side. When you buy gold in India, the most significant tax component is the goods and service tax or GST. 3% GST on gold value, regardless of whether you are buying physical gold like coins, bars or jewelry. A flat 3% GST is applied to the intrinsic value of the gold. So if you buy gold worth rupees 1 lakh, you will pay an additional 3000 as GST. 5% GST on making charges. If you are purchasing gold jewelry, there is an additional component, the making charges. These are essentially the labor cost involved in crafting the jewelry. A 5% GST is levied specifically on these making charges. For example, if your making charges are 10,000, you will pay 500 as GST on that. Import duty, it is also worth noting that a significant amount of gold, a customs duty is levied on this imported gold, which is already factored into the base price of gold you see in the market. While not a direct tax you pay at purchase, it certainly impacts the overall cost. Now let's move to the other side. What happens when you decide to sell your gold? Any profit you make from selling gold is subject to capital gain tax. The critical factor here is the holding period. How long you have owned the gold before selling it. First up, short-term capital gain or STCG. If you sell your physical gold like coins, bars or jewelry within 24 months of purchasing it, any profit is considered a short-term capital gain. For gold investments in dematerialized form like gold exchange traded funds, ETFs or gold mutual funds, the short-term period is 12 months or less. Taxation STCG is straightforward. The profit you make is added to your total income for the financial year and taxed according to your individual income tax liability. This means if you are in the 30% tax bracket, your STCG on gold will also be taxed at 30%. Next, we have long-term capital gain or LTCG. If you hold your physical gold for more than 24 months or your gold ETFs mutual funds for more than 12 months, the profit upon sale is classified as long-term capital gain. Taxation crucial updates. This is where a significant change has occurred recently as per amendments effective from July 23, 2024. LTCG on all forms of gold, be it physical gold, gold ETFs or gold mutual funds, is now taxed at a flat rate of 12.5% plus applicable surcharge and cess. No indexation benefit. What's very important to note is that the benefit of indexation has been removed for this investment. Previously, indexation helped adjust the purchase cost of inflation, thereby reducing the taxable gain. This is no longer applicable to LTCG on gold and equity-oriented mutual funds as per the latest amendments. Gold. So to quickly recap capital gains, this table should give you a clear overview. Now let's talk about a very popular and unique gold investment instrument, sovereign gold bonds. These are government securities denominated in grams of gold and are a fantastic way in gold without the hassle of physical storage. They also come with some excellent tax benefit. This is the biggest draw if you hold your SGBs till maturity, which is 8 years, 100% exempt from tax. This is a significant advantage over physical gold or gold ETFs. Interest income. SGBs also pay a fixed annual interest, currently 2.5% per annum, on the initial investment value. This interest is credited semi-annually and is taxable as income from other sources. at your applicable income tax slab rate. Redemption before maturity: if you redeem SGBs on the secondary market or through the early redemption option after 5 years but before 8 years, the capital gains will be taxable. If redeemed after 12 months, it will be LTCG at 12.5% without indexation. If redeemed within 12 months, it will be STCG as per your slab rate. Other consideration: gifts and wealth tax. A couple more quick points on gold taxation. Gift tax: if you receive gold as a gift, it can be taxable. However, there are exemptions. Gold received from specified relatives like spouse, parents, siblings, or received on the occasion of your wedding is tax exempt. Otherwise, if the aggregate value of gifts received in a financial year rupees 50,000 from non-relatives, the entire amount becomes taxable in the hands of the recipient. Wealth tax. Good news here: wealth tax in India was abolished from the financial year 2015-16, so you don't have to worry about an annual tax on your gold holdings. So there you have it, a comprehensive overview of gold taxation in India, from the GST you pay at purchase to the capital gains when you sell and the capital special benefit of sovereign gold bonds. It's essential to keep these rules in mind to optimize your gold investment. Remember, tax law can change, so it's always wise to consult with a financial advisor, especially for large investment. If you found this video helpful, please hit the like button and subscribe our YouTube channel. Share it with your friends and family for more financial insights.